Hey Gaurav, how are you?
I'm good, Bhaiya. How are you?
I'm fine, but not 100%. I have a bit of headache today.
Uh,
Yes, but not too much. So we'll continue learning. Nothing stops learning. So we are coming towards the end of passive investing part, right? We discussed about mutual fund ETFs, how to select quality mutual funds, and we also learned about power of compounding, etc. So now, even with passive investing, there is risk involved, right? Passive investing doesn't mean that if you are settling for lower amount of returns, then there are no risk involved or there are minimal risk. Still, you need to learn how to minimize your risk. So one of the one of the very good ways to minimize your risk is to diversify it.
okay.
You have heard the old adage, don't put all eggs in one basket.
Yes.
What it says about diversification, that okay, diversify it, spread your risk over different things. So same applies to investing. Spread your risk to different asset classes. Different asset classes can be, it can be your stocks, it can be your bonds. Stocks are equity investment, bonds etc are your bonds, FDRs etc are your debt investment. Another form of investment is gold or
Gold,
bullion,
yes.
gold. Yeah. Another fourth is real estate, जिसको commonly जिसको हम बोलते हैं property में investment करना. So another form is real estate, and another, there could be another investment which is investing in foreign assets, like investing in foreign currencies or investing in real estate located overseas, or investing in companies which are overseas, like people here in India can invest in stocks or USA stocks. So that is again investing in equities only, but we are investing in a different economy or different country. So the set of risk which impact Indian companies might not impact US companies, although both are impacted by global slowdown. But then
Yes.
again, with the regional impact is not there. So these are like basic investment areas. And now I'll tell you more in detail about what are risks and what we can do to control that risk. Okay. So
Okay.
as usual, I'll share a screen. As usual, I'll share a screen that I prepare. And where is that? Let me find it for you, son. Let me find it for you. Yeah, I got it. So I'll share the screen with you. Here it is. Do you see it?
Yes, Bhaiya.
Okay. So you see it clearly?
Yeah.
Fine. Okay. So again, Investopedia, I learned a lot from it. So I'll take this document straight away from Investopedia. Risk and diversification. Kindly read it for me.
Introduction. With the markets moving up and down like a six flag roller coaster, is there anything you can do to stomach the risk? Have you actually carefully considered the various risks that are associated with each investment you make? The fact is, many people either have no desire or no knowledge about how to protect themselves from unneeded risk. In this tutorial, we will introduce you to risk and give you a good foundation to understand the relationship between return and risk. What is risk? Whether
ठीक
it
है.
is, yeah,
बारी बारी listen listen. बारी बारी सुनते हैं. We hear it again and again. Higher risk, higher return. Low risk, low return. So everybody says, okay, that's a good idea. Everybody says, okay, invest in equities. Invest in equities. You hear it often because there will be there you will come across many people who will say, invest in equities. You are young. You should have larger share in equities. Your larger share in equities, like, so what, risk is there, but then again you have time and also and so forth. Although the person advising might not have no idea about the risks, or how we can actually control our risk even while being invested in equities. So first understand the type of risk, kind of risk, and then once you understand risk itself, then only you can know how to manage it or minimize it. So risk in investing, driving, or just walking down the street, everyone exposes themselves to risk. Your personality and lifestyle play a big role in how much risk you are comfortably able to take on. If you invest in stocks and have trouble sleeping at night, you are probably taking on too much risk. Risk is defined as the chance that an investment's actual return will be different than expected. This includes the possibility of losing some or all of the original investments. Okay. So like somebody is investing, let's say 100,000 in a particular stock. So it might go up, it might go down. So somebody thinks that, okay, over a 5-year period, I'll be making around, let's say, 80% out of that investment. Now, what happens after 5 years? After passage of 5 years, your investment of 100,000 rupees actually comes at 110,000. So one would say, okay, you are still in profit of 10%, but over a period of 5 years, you will say you actually have lost it.
Yeah.
Probably inflation might have increased a lot more during the last 5 years. Or take an example where you invested in a real estate asset at 1 crore rupees, and after 5 years, you see that value has decreased, and it is now it is difficult to sell it even at 80 lakh rupees. So that is the risk of price, that price risk. You are actually losing in value. So it could happen with any asset. You bought a band, you invested in bonds issued by some NBFC companies, but it defaulted. Have you heard of company named DHFL, Diwan Housing Finance
Yes.
Limited?
Yes, Bhaiya, I have
It,
heard
it,
that.
it went
Um,
bust. It went in September of 2018. It went
okay.
bust in September 2018. So all the bonds, etc., that were issued by this company went zero value. So those of us who work hard for every penny we earn, we have a hard time parting with money. Therefore, people with less disposable income tend to be by necessity more risk averse. On the other hand, end of spectrum, day traders feel if they aren't making dozens of trades a day, there is a problem. These people are risk lovers. When investing in stocks, bonds, or any other investment instrument, there is a lot more risk than you would think. In the next section, we will take a look at the different kind of risks that often threaten investors' return. Different types of risk: systematic risk, unsystematic risk. Kindly read what systematic risk is.
Yes. Systematic risk influences a large number of assets. A significant political event, for example, could affect several of the assets in your portfolio. It is virtually impossible to protect yourself against this type of risk.
Okay, go ahead. Keep reading.
Yeah.
Unsystematic.
Unsystematic risk is sometimes referred to as specific risk. This kind of risk affects a very small number of assets. An example is news that affects a specific stock, such as a sudden strike by employees. Diversification is the only way to protect yourself from unsystematic risk. We will discuss
Okay, I'll
Yeah.
give you an example of unsystematic risk here. Like few days back, there was this meeting of GST Council. They decided to put a GST of 28% on
On
gambling and online
gambling.
gaming, etc. Yeah, on online gambling, casinos, etc. So there is a company called Delta Corporation which is dealing in online gaming and casinos, etc. So business of that company was directly affected by this move. So that stock went down 25% by a whopping 25% in a single day, because probably market was not expecting any such news coming in, and it came to their surprise, and the share went down 25% in a single day. So that kind of risk is called unsystematic risk. तो पूरे सो इन हिंदी फैसे अगर पूरे सिस्टम को रिस्क हो गया, पूरा सिस्टम मतलब पूरे तंत्र को रिस्क हो गया, तो वो सिस्टमेटिक रिस्क है। पर एक पर्टिकुलर उसके ऑर्गन को, एक पर्टिकुलर पार्ट को रिस्क हुआ, तो दैट इज अनसिस्टमेटिक रिस्क। एक पर्टिकुलर कंपनी को हुआ, एक पर्टिकुलर ऑर्गेनाइजेशन को हुआ, एक पर्टिकुलर जैसे आपने यू हैव डिपॉजिटेड इन अ पर्टिकुलर बैंक, सो दैट बैंक हैड सम इश्यूज, you have invested, bought a certificate of deposit from a particular company, that company is delaying your payments or some default etc is there, then that is unsystematic risk, because pura tantra kharab nahi hua hai. It's not about whole banking system or some default at the sovereign level. The default, if it's coming from particular company or a particular piece of investment, then it is called unsystematic risk. Now keep on reading.
Yeah. Credit risk is the risk that a company or individual will be unable to pay the contractual interest or principal on its debt obligation. This type of risk is of particular concern to investors who hold bonds in the portfolios.
क्रेडिट रिस्क बेसिकली आपने किसी को पैसा दिया और पैसा वापस नहीं मिला, राइट?
Okay, yeah.
Country risk refers to risk that a country won't be able to honor its financial commitment. When a country defaults on its obligation, this can harm the performance of all other financial instruments in that country as well as other countries. It has a relation with country risk applies to stocks, bond, mutual fund, option in future, and that are issued with a particular country. This type of risk is almost often seen in emerging market or countries that have a several deficit. Most recent example that you must have heard is Sri Lanka.
Yes.
Sri Lanka defaulted. So what happened with those people? Interest rate went up to 50-70%. I'm not too sure. And then, you know, all those deposits, etc., which people think that is a good long-term investment, etc., all went down the drain. So that kind of country risk impacts each and every investment in that country. Foreign exchange risk. Foreign exchange risk is very simple to understand. Like NRI friend, I give you an example of India. NRI friend invest $100,000 in India.
Okay.
And let's say he has invested into a real estate asset. He bought some 2 BHK flat in a particular area. He paid $100,000 10 years ago. So at that time, let's say rupee dollar conversion rate was 50 rupees. So now after 10 years, he sells that building or that flat for rupees 80 lakhs. He sells that flat for rupees 80 lakhs. Now, obviously, he's located, let's say in some USA city. So he wants that money in dollar form only. So now he sells that in 80 lakhs after paying taxes or whatever, etc. Let's say he's left with 75 lakh rupees. Now he converts his money into 75 lakhs into dollars. Current exchange rate is around 80 to 83. So he'll be getting only about $90,000. 10 years back, he invested $100,000. Now he is getting $90,000. So even if the flat has gone from 50 lakhs to 80 lakhs, but actually what he's getting a depreciation of 10% on his investment, even after keeping that asset for 10 years.
10 years.
So the larger part, what happened? He invested in a country where currency was devaluing. So he faced that devaluation risk. So this is also foreign exchange risk. Foreign exchange risk also comes from somebody who is doing foreign currency transaction. Let's say we saw last year Russia-Ukraine war broke out. Then there was huge wide swings in ruble prices. There was huge swing in ruble prices. Ruble went down 20%, and then over the next few weeks it recovered, etc. So anybody dealing with Russia on commercial basis, some trading business somebody is doing, then they are running huge risk of foreign currency. They might be dealing in like businesses where their net profit might be 2-3%, but the swings in currency are 10-20%. That their several years of income can be wiped out in one such situation. Interest rate risk. Interest rate risk is investment's value will be changed in result of change in interest rate. In March this year, March 2023, we saw the Silicon Valley Bank go bankrupt. So what the Silicon Valley Bank was doing, Silicon Valley Bank was, if I can't recall, but it was investing their deposits into some bonds. So bonds and interest prices have an inverse relation. If interest rates are going higher, bond prices are going lower. We discussed in last class. So US interest rate went up unprecedented from like 1%, 0.5% interest rate to it went to 5%. So the bond prices plummeted very sharply, very sharply. So and then the point arrived that they were not so the bank had most of its investment into bonds, which we consider to be most safest, but the value came down so much, investment value came down so much that they were not able to maintain their solvency, and the SVB bank was forced to file bankruptcy. So that was interest rate risk on their investment. So such situation, although rare, but do happen. Political risk represents the financial risk that a country government will suddenly change its policy. It's a major reason why developing country lack country foreign investment. So many countries in Africa carry huge political risk. There is a lot of political unrest in some of the countries, and there is a fear of civil war breaking out. Some of the countries in Middle East also face the same kind of risk. So they do not attract foreign investment to their full potential. So in more mature and stable countries, which have greater political stability, they gain higher amount of investments from overseas. Market risk. It is the most familiar of all the risks, also referred to as the volatility. Market risk is the day-to-day fluctuations in the stock prices. Market risk applies mainly to the stocks and options. As a whole, stocks tend to perform well during a bull market and poorly during the bear market. So market risk is the daily ups and downs and the overall market cycle. Overall market cycle that we see, some people say that there's a 10-year market cycle, some people say 6-year market cycle, whatever, to each his own. But thing is that market do tend to show, just like economic cycle, stock market have also a cycle of boom and bust. I have seen it myself. Okay, so the risk. So now we move on. After understanding different kind of risks, then there has to be some ways to manage them. The risk reward trade-off. The risk reward trade-off could easily be called the iron stomach test, deciding what amount of risk you can take on in one of the most important investment decision you will make. The risk return trade-off is the balance an investor may decide on between the desire of the lowest possible risk or the highest possible return. Remember to keep in mind that the low level of uncertainty are associated with low potential return, high level of certainty are associated with high potential risk. This is very important. ये बहुत इंपॉर्टेंट है. आप समझो, जहां पे सर्टेनिटी नहीं है, where there is uncertainty, there is higher risk.
Yes.
Like you are buying, let's say, 5-year bond issued by Reserve Bank of India.
Okay.
Now looking at the India's growth and stability in Indian economy, so on a lot of parameters, there is a very, very, very high amount of certainty that after 5 years, Reserve Bank of India will honor the bonds issued. So for somebody who wants a certain income would be running towards buying those bonds. So when certainty is high, certainty of the capital, safety of capital, and certainty of the returns, then the returns are high. So similarly, investment in gold also do not get too much of return, because gold is very reliable and stable asset. So gold also gets less amount of returns. Kindly read on the risk-free rate from the
risk-free rate of return is usually signified by the quoted yield of US government securities. Because the government very rarely defaults on loans, let's suppose that the risk-free rate is currently 6%. Therefore, for virtually no risk, an investor can earn 6% per year on his or on her money. But who wants 6% when index funds are averaging 12 to 14.5% per year? Remember that index funds don't return 14.5% per year. Instead, they return minus 5% one year and 25% the next, and so on. In other words, in order to receive the higher return, investors must also take on considerably more risk.
Okay, so the idea here is that there is a one certainty of risk. Like, let's say you are depositing in bank FD, and they are paying an interest rate. Interest payout is every 6 months, and rate of interest is 6%. So every half year you will get 3% into your bank. That is very stable curve. With the stock market, it doesn't happen so. 2-3 years you will get good returns. Like what we saw. Let's say somebody who invested in stock market in year 2017. We saw a kind of market coming down in 2000. No, even before COVID, we saw market coming down in 2018.
Okay.
We saw that, the bankruptcy of DHFL and other few financial institutions, and then the mid cap space came down crumbling. And then after 1.5 years from that, we saw this COVID situation in February and March 2020. So we saw market plummeting 30-40% in few weeks only. And then we saw the recovery. So somebody who invested in 2017 has already seen a roller coaster ride. And it's psychologically, it's very difficult when we are in 2021 and when we see the COVID situation all around us. And even in 2022, by 2022 it was much better, but even in 2020 and 2021 we saw different waves of COVID. So in those situations, if you are if you are invested in an asset such as equities, which is going through a roller coaster ride, then it's very difficult to manage or understand these situations. On the hindsight, it might look easy that market finally went up, but nobody knew what happened. So it is very these are the kind of risks we are talking about. So now we come to how to curtail this risk. So for risk, so first part is diversifying your portfolio. Kindly read on.
Yeah. With the stock markets bouncing up and down 5% every week, individual investors clearly need a safety net. Diversification can work this way and can prevent your entire portfolio from losing value. Diversifying your portfolio may not be the sexiest of the investment topics. Still, most investments professionals agree that while it does not guarantee against a loss, diversification is the most important component to helping you reach your long-range financial goals while minimizing your risk. Keep in mind, however, that no matter how much diversification you do, it can never reduce risk down to zero. What do you need to have a well diversified portfolio? There are three main things you should do to ensure that you are adequately diversified. First one, your portfolio should be spread among many different investment vehicles such as cash, stocks, bonds, mutual funds, and perhaps even some real estate. Second, your securities should vary in risk. You are not vary in risk. You are not restricted to picking only blue chip stocks. In fact, the opposite is true. Picking different investment with different rates of return will ensure that large gains offset losses in other areas. Keep in mind that this doesn't mean that you need to jump into high risk investments such as penny stocks. Your securities should vary by industry, minimizing unsystematic risk to small group of companies. Another
Okay.
question, yeah.
Yeah. So what happens like during COVID times, we saw a huge boom in technology company stocks. Everything related to technology, this Zoom meeting that we are
Yes,
holding.
online, yeah.
Share of this Zoom company went up to $500 per share, and then it plummeted to I think about 10% only. So it 90% fall. It saw similar things happen with Apple stocks or Amazon stocks. So all these tech companies saw a sharp move during to COVID times. Everybody thought that whole world will shift to online things and all, but soon after after 1 or 1.5 years, everybody saw the reality and they finally realized that all these stocks were overvalued. And so those people who had accumulated all the tech industry stocks, so almost everything in the tech space went down. So this is called this is the industry risk. So to avoid that risk, howsoever lucrative it might feel, but you should actually diversify your investment
Portfolio.
into different kind of companies, into tech companies, into FMCG companies, into minerals, it's oil, pharma, different. So those who are you at least like 5-7 areas you should divide your investment. And in this article, we are not saying investment in gold. But for us Indians, because gold is an international asset and our currency is devaluing and it keeps on devaluing because of the fiscal deficit that we have. So, fiscal deficit or budgetary deficit that we have. So, it is a good idea that we keep some of the investment in actual physical gold and also gold bonds. We can discuss that on that later, but having investment in some of the in gold is a good idea. So uh, further move on. Another question people always ask is how many stocks they should buy to reduce the risk of portfolio. The portfolio theory tells us that after 10, 12 diversify stock, as you are very close to optimal diversification, this doesn't mean buying 12 internet or tech stock will give you optimal diversification. Okay. So this is what we discussed. Somebody invested in 10 to 15 different stocks, but they all buy what IT stock. Or somebody said, okay, we will always say, I have actually seen people doing this, that somebody has 1 crore, so they invested all their money in pharma stocks. They read some article or they talked to someone and they were too impressed with the possible growth of pharma company. Let's say 8-10 years back. So they were so impressed. Say they invested all their money in pharma companies and pharma companies went up. That person saw the investment going up 30-40% in a short duration, and then everything came down far lower than what he invested, and it took several years before he actually realized his actual money that he invested. So there were several years lost waiting for his money to recover. So investing even into visibly safer avenues like investing into pharma companies is considered safer because they are producing medicines. So we believe that. So we believe that, okay, medicine will always be selling. But still what happened? That they lost value and it took about a decade for him to recover his full investment value. So if he had diversified into different companies like tech companies, pharma companies, finance companies, oil and gas, etc., then his portfolio would have performed much, much better during these 10 years period. So now read out the conclusion, please.
Different individuals will have different tolerance for risk. Tolerance is not static, it will change as your life does. As you grow older, tolerance will usually shrink as more and more obligations come up, including retirement. There are several different types of risk involved in financial transactions. I hope we have helped shed some light on this risk. Achieving the right balance between risk and return will ensure that you achieve your financial goals while allowing you to get a good
Night's
night
rest.
rest.
Okay. In this thing, which is not covered in this article, listen, they are not talking about relationship between different asset classes.
Okay.
In a good diversified investment portfolio, I tell you what happens. During COVID times when, and also further when we saw war break between Russia and Ukraine, gold prices started going up and stock market came down. We saw similar things during COVID times as well. Stock market plummeting sharply, but bond prices and interest rate also came down because there was no demand for money. So those who were holding on to bond prices went up sharply. Bond prices went up sharply and stock prices came down. Gold prices, I think, went up. So, and property prices, real estate prices came down. So there is a inverse correlation between debt and equity, etc., and bond prices and stock prices. So what happens if you are holding your portfolio into different assets? Risk at portfolio level is minimized because let's say bond prices are going up and down and stock prices are going up and down. But when you combine these stocks and bonds, you might actually have a more stable curve.
Yes.
Because they have inverse correlation. One is going up, one is going down. So this is also very important to learn relationship between your different asset classes.
Okay.
Like rupee and dollar. If we are saying that rupee is devaluing, then dollar is going up. So if you have investment something in dollar terms, if you are investing something in USA and rupee is going down, then you won't be complaining too much because your US assets are going up. So this is how you can control your different kind of risks, various risks that we have studied earlier, like credit risk, systematic, country, foreign exchange. If you diversify your investment over more than one country, you can overcome country risk. If you foreign exchange risk, if you invest your money into different kind of foreign exchange or different currencies, you can minimize your foreign exchange risk. If you have invested into different market instruments, you have reduced your market risks. Market risk can also be reduced by diversification, etc. So by applying simple methods, you can actually control large part of your risk. Okay, son?
Yes,
So
भैया.
do study it. Do study this in detail again. And if you have any queries, do come back to me. Okay?
Okay. Okay, भैया.
Oh, take care. Bye-bye.
Bye.